I'm Jessica Minton for IB Times TV, reporting from the floor of the New York Stock Exchange, where stocks fell in early trading after a bigger than expected drop in jobless claims. But in other news this week was the announcement from the IntercontinentalExchange and NYSE Euronext about clearing one regulatory hurdle in their pending acquisition. Economist Stephen Guilfoyle will weigh in about that situation going on right now and what will happen to the future of the trading floor. The Intercontinental Exchange announced in December that it's agreed to acquire NYSE Euronext in a deal that would create one of the largest global exchange groups. ICE and NYSE Euronext said Tuesday that the expiration of the waiting period in connection with the proposed acquisition ended on Friday, February 15th, which satisfies one of the regulatory requirements for completion of the merger. The transaction remains subject to additional regulatory requirements with the U.S. Securities and Exchange Commission, including competition approvals in Europe. Merging NYSE Euronext with the second largest futures market emphasizes the diminishing influence of the 220-year-old New York Stock Exchange, as it's seen its shares of trading in stocks listed on the exchange decline to 21% from 82% in the mid-1980s. But what will happen to the future of the historic trading floor? The Intercontinental Exchange and NYSE Euronext announced this week that they've cleared the pending hurdle, or one of the hurdles rather, for the acquisition. Now, you worked on the floor for 25 years. Is there fear that ICE will shut down the trading floor, similar to what had happened when ICE bought the New York Board of Trade?
Well, I think that kind of fear is natural. And traders obviously look out for their livelihood. Funny, when I wrote about this back when the merge was announced, I got warnings back on my website, comments back from NYBOT traders who had been displaced. So they were like, don't be so sure it'll be okay. I'm telling you, these guys are out to hurt you. I don't think they're out to hurt these guys. Now, I don't know, I'm not in their heads, okay? But they're buying a brand here. And part of that brand, part of the marketing of that brand is the floor and its people. So they're not going to buy this place to make it look like a bowling alley, which would be very bad for business, I believe. It would be bad for listings, and listing fees are important to the exchange. So I do think these guys may see some kind of value in what the exchange brings. They may see value in the flow of information, or value at the point of sale that only floor brokers can bring with parity at the point of sale, which would matter if volumes were to be centralized more at this point of sale and not so scattered. So they may see an undervalued asset and think maybe they can bring some value back to it. That might be part of the reason why they're purchasing the exchange.
You did bring up on your website shortly after the acquisition was announced that the NYSE's shares of trading volume in its own listings has dropped in the recent years. Why has the percentage dropped so much?
Well, there are a couple reasons. One is competition from various electronic exchanges. I think there's something like 43 electronic exchanges that trade listed shares right now. And in a less human environment, is there really an advantage here at the point of sale as opposed to those? Some people say no. The other reason would be dark pools. Dark pools have captured a large percentage of trading volume, and dark pools are largely immoral, in my view, because what they do is they hide, they skew someone's ability to assess risk, ability to assess supply and demand, which is what the exchange stands for, what fair trade stands for. So in my opinion, dark pools are counterproductive when you're trying to reach fair trade, which is what this country should always reach when they're trying to have a free market, let's say. So there are a lot of reasons why volumes have dropped to, I don't know what they trade now, maybe 20-21% of their own volume here at the exchange. There are a lot of reasons why, but I do believe if you were to eliminate access to these dark pools and access to these less regulated electronic exchanges, because only the major exchanges are regulated. There's no rules really in these other places, and you can get hurt. You could have 43 different last sales in any given security at any time, which is kind of ridiculous. So I think if regulation is increased, and dark pools are, I don't think you could ever eliminate them, but if access was decreased, there is more value here than people think.
How will this affect the future of how stocks are traded on the floor?
Well, if you listen to them speak, it wouldn't. But I think that they are going within an angle that there is some value here. So you may see increased importance to being at the point of sale, to a floor broker and a specialist standing somewhere and competing for best price against their competitors or against each other, against other exchanges, but you'll have a better flow of information if you're in a trading crowd at the exchange. Right now, that isn't really the case because it's become almost an electronic exchange. But I guess the potential is there that you can go back the other way and increase the human element. And that would be the only thing that would differentiate an exchange from any place else. So there is something different there, and maybe that something different has value.
Thank you for joining us, Stephen.
Anytime.
The deal is expected to close in the second half of 2013, but is subject to regulatory approval by the US, Europe, as well as being approved by shareholders of both companies. I'm Jessica Minton for IP Times TV.